Hi guys, and welcome to another week ahead video. Now in this upcoming week we have a very quiet economic data calendar, with the main highlight being the flash PMI numbers coming out on Friday for the EU, the UK as well as the US. But apart from that, of course, a lot of focus will still turn towards the virus developments. On Monday and Tuesday we have two very important reports coming out from AstraZeneca as well as Moderna with regards to their phase 1 clinical trials for the vaccines. That'll be important to watch in the week ahead. And then apart from that, just the ongoing concerns about the second wave or resurgence of the virus. Apart from that, there will be stimulus focus as well. So join me now, jumping into the video to see how we're preparing for this week's events and hopefully how we can trade them in this upcoming week as well. This past week, we saw some outsized moves at the start of the week as the coronavirus, which remains the current major market macro theme, took center stage once again. And this very helpful table from Statsta shows why this was such a big deal, with California being the biggest GDP contributor in the US by quite a very big margin. So it was only logical for equities to have a little bit of a sell-off on the back of that news. Now fast forward that to the very next day, we had a complete reversal of the entire move as positive vaccine news from Moderna gave risk assets a real reason to feel optimistic once more. Now, the chart below with these two catalysts in mind shows why virus and virus-related developments are still a key macro driver for the markets right now. Another interesting point observed this week was that the stronger than anticipated activity data from both China in the form of Q2 GDP as well as US retail sales failed to see any meaningful upside in markets, despite surprising to the upside. Now, in our report 2 weeks back, we highlighted that the market ear noted a growing divergence between the City Economic Surprise Index and something like the S&P 500. Now, that divergence has continued to grow lately, with the Economic Surprise Index continuing to rise and the S&P 500 continuing to move sideways. And from the recent lackluster reactions to better than expected data, it does seem that their prediction is starting to play out as the market has grown very accustomed to upside surprises in recent data sets. Now, we also had another round of weekly jobless claims with some further bleak looking numbers. After the initial moves lower in jobless claims, the recent trend would suggest that the labor market recovery is currently stalling. And the other caveat that's important to keep in mind about the US labor market is the PPP program. Now, the extra payments of $600 per week as part of the CARES Act has basically helped to give households some much needed support and aid in these times, but that is coming to an end very soon. And it seems that both political parties in the US want another round of relief, but the two sides are still very far apart on what the relief bill should look like, with the US administration recently saying that the bill must include a payroll tax cut as well. Now, apart from that, we also had some reports on Friday from Fitch saying that the reinstatement of lockdown measures and the uncontrollable rise in virus cases could potentially threaten the US recovery. Now, to be fair, this shouldn't really be much of a surprise to markets and is the exact reason the market has been reacting negatively to lockdown measures in the first place. However, it does show that more economists and more analysts are starting to take on a more cautious view that everything isn't really as well as it might seem, even though the recent V-shaped looking charts might look that way. Now, does that mean that the risk rally we've seen is over as the reality of the severity starts to become more and more evident? Possibly, but obviously only time will tell. A recent article by Adam Button, the chief currency analyst at Forex Live, reminded us that betting against the US consumer has always been a bad bet. So what does all of this bad data, what does all of the conflicting narratives mean for us right now? It means we need to be careful with counting our medium-term buyers trade eggs before they hatch, and be a little bit more nimbler by taking advantage of those shorter-term sentiment opportunities in these very uncertain and choppy environments. Now, looking at the week ahead in terms of economic data, it's going to be very uneventful, barring the flash PMI data we have scheduled for the Eurozone, the UK and US on Friday. However, the current main macro drivers should provide some short-term opportunities to take advantage of. The first one, the virus developments. With a week that will be very thin with the economic data, any significant developments, whether positive or negative, could create sizable moves in the market this upcoming week. There are two sides to the virus debacle in financial markets right now. On the one side, we have the continuous dripping headlines of positive or promising vaccine or drug-related news which has proven to be a great source of short-term risk on flows. Now, the recent vaccine announcements that made the most waves has been focused on progress showing both antibody as well as T-cell generation in tests. So look out for any drug news with those two specific topics in mind. Also, recent clinical trials have done little to address the age group who are most at risk with the virus. So any vaccine trials that show progress in helping those who are most at risk will be a significant factor as well. Now, the two big events to watch on the virus front this week will be on Monday. We have the company called AstraZeneca. They will publish their phase 1 test results in the Lancet Medical Journal. Now, according to a Bloomberg article, the trial started in April and saw more than 1,000 shots tested on healthy adult volunteers. And then on Tuesday, we also see results from Moderna regarding their early stage test of 45 people that apparently showed the vaccine raised levels of antibodies that fight the virus. Now, a lot of the good news about these two reports have already been leaked, so take them with a pinch of salt this week. However, the market's propensity for positive news will probably spark some risk on flows if there are some hidden nuggets in the reports that point to even more positive results than markets are currently aware of. Then the other side of the coin, we have the dreaded second wave or virus resurgence and the subsequent reinstatement of severe lockdown measures which accompanies it. So we saw the type of reaction in risk assets when California governor reinstated those certain lockdown measures with that drop to the downside we can see in the S&P. So any further reinstatements in key US states or other parts of the world like Europe or China could see similar reactions as it threatens the hopes of a meaningful and robust global economic recovery. Looking at stimulus developments, as we noted earlier, there are a few key US stimulus measures that are set to expire anytime soon. Now, the biggest question mark will be on the PPP and how an end to that without any other alternatives would impact consumer confidence and spending. Retail sales has had 2 solid months in both May and June, but many analysts have poured cold water on the numbers, saying that the government stimulus checks paved the way for these tremendous gains. So if these measures run out without any replacements, that could pose a problem for the recovery narrative. Thus, any key developments regarding new programs or additional programs or extensions of the current ones will be in focus for the markets this week and would offer some signs of relief that the hit to consumer activity might be mitigated to some extent. Third one to watch, earnings season continues. Another week of earnings is also on the schedule with some big names like Tesla, Microsoft and Twitter. So much bad news have been baked into earnings expectations that 80% of companies that reported so far has beat the bad expectations. As we noted last week, the anticipated drop of negative 44% on earnings poses a bigger upside risk than a downside one, as the market is already poised for bad numbers. Now, with earnings being more backward looking and with market participants focused on the virus developments, we might see another week of more muted reactions to these numbers. Above is a very handy calendar from the team of at Earnings Whispers that highlights the most important names reporting in the week ahead. Looking at economic data and recovery hopes as well, the main data highlight this week will be the July PMI numbers for the EU, UK and the US. These numbers have continuously beat their expectations recently, and the markets will be eyeing key metrics to see whether we can cross that very important 50 level on the majority of them. Now, some of the recent PMI data has been very encouraging. But of course, as they are diffusion indexes, there are some caveats that mean the upside surprises will run into some difficulty in the upcoming reports. However, the market has continually discounted the negatives associated with the data surprises and will probably latch onto any prints above 50, especially ones that come in above the market's maximum expectations as well. Another point to consider is the EU Recovery Fund discussions taking place this weekend. Friday's session ended with further disagreements, but latest news out today, which is Saturday, is that EU Council President Michel has kept the fund proposal at 750 billion euros, but has reduced the amount of grants from 500 billion to 450 billion. And at the time of writing, the change was well received on face value, at least, as Dutch diplomats said that it was a serious step in the right direction. So markets we're very optimistic going into the summit that the possibility of a deal might be on the table. So any breakthroughs over the weekend or major setbacks, of course, will be important for risk assets at the start of the week. Then looking at possible sentiment drivers this week, starting with the hawkish ones. In terms of virus developments, as usual, any surprises on the virus front in terms of breakthroughs or positive results can be market moving this week and create some nice risk on flows. In terms of the AstraZeneca and Moderna news, a lot of the good news has been leaked already, but any surprise positives can give risk assets another shot in the arm. So definitely 2 ones we need to keep track of. in terms of stimulus developments, with the pressure increasing on US political parties to get another relief bill passed, we might be in store for some good news in the week ahead with additional programs or extensions of the current ones. The last thing the US wants right now, after this major virus ordeal that they're still going through, is to discourage consumer spending and by allowing political differences from threatening the US economic recovery. So definitely one point we need to watch closely. Also, earnings season, we have a few big names in the mix for earnings, including Tesla, which will be very interesting to watch after its recent monster rally, as well as giving up some of those gains in the later part of this current week. The risk of upside surprises remains intact though, and could be a possible catalyst for risk on flows if we see big beats in the current very low expectation hurdle. Data and economic recovery hopes. PMI data could offer the markets another reason to feel positive if we see further jumps in the diffusion indexes, especially if we see solid beats above 50. Also keep track of developments regarding the EU Recovery Fund, as a price approval could set risk assets off to a very good and positive start at the open of the Asia Pac session and could set an overall positive tone for the rest of the week as well. Looking at potential dovish sentiment shift starting with the virus again, further reinstatement of lockdowns in key US states like Texas and Florida. Remember, they're part of the top 4 biggest US GDP contributors. That could spark off some additional risk off flows as well, like we saw on Monday from California. Also keep track of developments like this in other countries as well as Spain, starting also now to show some worrying signs in terms of increased cases. Once again, the vaccine trial news has been largely priced in, the ones from AstraZeneca and Moderna. So if there's any major negatives coming out from these trials, that could see a very quick reprice and be negative for risk assets as well. So keep that on the radar. Stimulus developments, if we see further political bickering, keeping US consumers in the dark over whether they will receive additional support could weigh on risk sentiment as well. So watch out for any big breakdowns in discussions and cross-party negotiations. Also, earnings, with expectations so low as it is, it won't be very difficult for companies to show better than expected earnings. However, any massive downgrades to Q3 revenues or future expectations like we saw from Netflix this week, especially surrounding employment, etc., could spark some risk of flows. As always, attention to detail when it comes to these releases will be very important. Then in terms of data and recovery hopes as well, diffusion indexes like PMIs are facing a tough road ahead as the current base effect advantages dissipates. So any surprise stall in the recent rise could spark some sobering repricing of the hopes of that very fast V-shaped recovery. And with the resurgence in virus cases recently, the US market PMIs will also be very important to gauge, seeing how businesses have changed in terms of confidence, if any. Looking at the trading plan for the week ahead, with the very light economic calendar, our main focus will be on the overall risk flows, with attention tilting towards the outcome of the EU summit this weekend, accompanying with the vaccine trials we have on Monday and Tuesday, the flash PMI data on Friday, and then of course the continuation of earnings season. Now, with the biggest focus tilting to risk flows, we would look to take advantage of risk sentiment instruments such as equities like the S&P 500 and high beta currencies like the Aussie, the Kiwi, the CAD, and safe haven assets like the US dollar, Japanese yen, Swiss franc, gold, and of course US government bonds. Now, apart from that, the euro dollar will also be a key focus for us this week as well, with the looming EU summit this weekend. Also the overall reflation narrative. So remember, the story for the recent euro strength is not only being due to the EU Recovery Fund, but it's also a story about broad-based US dollar weakness. And as long as the hopes for a very quick global recovery is alive and international starts to increase once more, the expectations for a lower dollar will continue to rise and is another key tailwind to keep in mind for the euro dollar as a potential additional proxy for markets to express risk on flows. Now, as our main focus stays on overall risk sentiment, do remember not to trade risk sentiment shifts in a vacuum. Always consider the underlying macro themes and drivers for the individual assets as well. And in this type of market environment, it can be very tricky and risky to trade into any upcoming events. This is why we would wait for sentiment shift to occur and not trade into any events this week. In this type of market environment, it's always wise not to be too ambitious with your targets. It's best to stick to those shorter targets, aiming for those S1, those R1 pivot points, or those ADR highs and lows. Obviously, also incorporating any of your other key technical levels like support and resistance, psychological price levels, etc., for the highest probability entries and exits.